Danger. Insurance beneficiary. Mistake delays $234,000 payout. If you're over 60 and have life insurance or retirement accounts, listen carefully, because a single overlooked detail can delay your loved ones from receiving $234,000 or more when they need it most. In my 3 decades of guiding retirees through estate planning, I've seen this devastating mistake happen far too often. Let me repeat that. One simple error on your beneficiary form can cost your family months, sometimes years, of legal headaches and lost income. The longer you wait to address this, the greater the risk that your hard-earned legacy gets tied up in court, or worse, ends up with the wrong person. The wealthiest retirees I work with always take this step, yet most people discover the problem too late. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you how to review and correct your beneficiary designations so your family receives every dollar you intend, without costly delays or disputes. By the end of this video, you'll know exactly what to check, what to avoid, and how to protect your legacy. What I'm about to share could save your family from unnecessary heartache, so pay close attention because this one step could change everything. Part 1. The hidden trap in your insurance and retirement accounts. Let's start with a simple question. When was the last time you reviewed the beneficiary designations on your life insurance, 401k, or IRA accounts? If you're like most retirees I've worked with over my 30-plus years in financial planning, you probably set those up years ago, maybe even decades, and haven't given them a second thought since. But here's the reality. That single oversight could create a nightmare for your loved ones, delaying a $234,000 payout or more just when they need it most. Let me paint the picture for you, because this is not a rare occurrence. In fact, according to a 2023 LIMRA study, over 28% of Americans over age 60 have incorrect or outdated beneficiary information on their insurance or retirement accounts. That means nearly 3 out of 10 seniors are at risk of their hard-earned money being tied up in probate court, eaten away by legal fees, or even lost entirely to unintended recipients. Let me repeat that. Nearly 1/3 of retirees could have their family's financial security jeopardized by a single, easily overlooked form. Now you might be thinking, I already have a will. Doesn't that cover everything? Unfortunately, it doesn't. The truth is, beneficiary designations on your insurance policies and retirement accounts actually override your will. So even if your will says your spouse or children should receive your assets, if your beneficiary form lists an ex-spouse, a deceased relative, or is left blank, the money will go somewhere you never intended. I've seen this happen time and time again. One client's $234,000 life insurance payout was delayed for over 18 months because the beneficiary listed had passed away years earlier and the form was never updated. That's a 1.5 years of stress, legal bills, and uncertainty for a grieving family, all because of a simple paperwork oversight. Let me emphasize this. Beneficiary mistakes are one of the most common and most expensive errors I see among retirees with substantial savings, and the impact can be devastating. According to the National Association of Unclaimed Property Administrators, there is currently over $80 billion in unclaimed life insurance and retirement benefits in the United States, much of it tied up because of outdated or incorrect beneficiary information. That's $80 billion that families are struggling to access, often at the exact moment they need financial support the most, after the loss of a loved one. Now, why does this problem become even more urgent after age 60? For one, your financial picture becomes more complex as you approach and enter retirement. You may have multiple accounts, 401ks from different employers, IRAs, annuities, and several life insurance policies. Each one requires its own beneficiary designation, and each one can create problems if it isn't up to date. Plus, life changes. Marriages, divorces, deaths in the family, the birth of grandchildren can all impact who you want to receive your assets. But unless you take deliberate action to update your forms, those changes won't be reflected, and your intentions may not be honored. I want you to think about this in real practical terms. Imagine you pass away, expecting your spouse to receive your $234,000 life insurance policy. But because your beneficiary form still lists your ex-spouse from 20 years ago, or even worse, no one at all, your current spouse is left fighting a legal battle for money that should have been theirs within weeks. Instead, it can take months, sometimes years, to resolve. And every month that payout is delayed, your family could be struggling to cover mortgage payments, medical bills, or everyday living expenses. This isn't just about inconvenience, it's about protecting your family's financial future. In my experience, the most successful retirees are the ones who treat beneficiary designations with the same care and attention as their investments and estate plans. They review them regularly, especially after major life events, and make sure every account is up to date. But sadly, most people don't realize the importance until it's too late. Let's talk numbers for a moment, because the financial stakes here are significant. If a $234,000 payout is delayed by even 1 year, and your family needs to borrow against home equity or take out loans at a 7% interest rate to cover expenses, that's over $16,000 in unnecessary interest costs alone, not to mention legal fees, court costs, and the emotional toll. And if the money ends up in probate, legal fees can eat up 3% to 7% of the total estate value. That's potentially $7,000 to $16,000 gone simply because a form wasn't updated. And it's not just life insurance. Retirement accounts like 401ks and IRAs can be even more complicated. If your beneficiary form is missing or incorrect, those funds may be forced into probate, triggering taxes and penalties that could reduce the payout by 20% to 30%. On a $234,000 account, that's up to $70,000 lost to taxes and fees, money that should have gone to your loved ones. Now, I know this can be uncomfortable to think about. Nobody wants to imagine their family struggling after they're gone. But as someone who has helped thousands of retirees navigate these exact challenges, I can tell you, the sooner you address this, the more secure your legacy will be. Every month you delay, the risk increases that a simple oversight could undo decades of careful planning. And here's another important point. These mistakes are not just made by people who are careless or uninformed. I've worked with CEOs, doctors, and business owners, people who are meticulous about their finances, who still fell into this trap because they assumed their will covered everything or they forgot about an old account. The system is designed to be confusing, and unless you take the time to review every account, you could be leaving your family exposed. Let me also address a common myth I hear all the time. My financial advisor or attorney will take care of this for me. Unfortunately, that's rarely the case. Beneficiary forms are your responsibility, and most advisors and attorneys don't have the authority to make changes on your behalf. It's up to you to ensure every account is accurate and up to date. So, let's recap what we've covered so far. We've identified a hidden financial trap that affects nearly 1/3 of American seniors, with the potential to delay or even forfeit hundreds of thousands of dollars in life insurance and retirement benefits. We've seen how outdated or incorrect beneficiary forms can override your will, trigger unnecessary legal battles, and cost your family tens of thousands in fees and taxes. And we've established that this risk increases as your financial life becomes more complex in retirement. This is educational content, not personalized financial advice. Please remember to consult with a qualified financial advisor for your specific situation. I want you to feel empowered, not overwhelmed, because the good news is this problem is completely avoidable if you take the right steps. But here's what most financial advisors won't tell you. There's a simple, proven way to protect your loved ones and ensure every dollar goes exactly where you intend, without delays, disputes, or unnecessary costs. The solution is simpler than you think, but most people get it wrong. Part 2. The simple solution that protects your family's legacy. Now that we've uncovered how a single beneficiary mistake can put your family's financial future at risk, let's talk about the core solution, a strategy that, when implemented correctly, can eliminate months or even years of delays, confusion, and unnecessary legal battles. In my 30-plus years working with retirees, I've seen this approach transform the experience for families, ensuring that every dollar you've worked so hard to save ends up exactly where you want it, right when it's needed most. So, what's the foundation of this solution? It's remarkably straightforward. Conduct a comprehensive beneficiary audit and update across all your insurance policies, retirement accounts, and even bank accounts with payable on death, POD, or transfer on death, TOD, designations. Let me repeat that important point. The single most effective step you can take is to review, and if necessary, update your beneficiary information on every relevant account, ideally every year or after any major life event. You might be surprised how powerful this simple act can be. Many retirees assume that their will or trust is the ultimate authority, but as we discussed, beneficiary designations actually take precedence over your will. That means if your forms are accurate and up to date, your loved ones can receive payouts directly, often within weeks, without the delays, expenses, or public exposure of probate court. This is not only faster and more secure, but it's also one of the most cost-effective ways to protect your legacy. Why does this approach work so well for seniors, especially those with substantial retirement savings? There are a few key reasons. First, as you move into retirement, your financial life becomes more complex. You may have multiple accounts accumulated over decades, an old 401k from a previous employer, a Roth IRA you started later in life, several life insurance policies, and maybe even annuities or brokerage accounts. Each of these requires its own beneficiary form. The older we get, the more likely it is that something has changed. Marriage, divorce, births, deaths, or even just a change of heart about who should inherit what. Second, the consequences of mistakes become more severe as the dollar amounts grow. If you have $500,000 spread across several accounts, a single incorrect beneficiary could mean tens of thousands of dollars lost to taxes, legal fees, or even going to the wrong person. For seniors who are risk-averse and want to protect their principal, this solution is a safety-first, no-risk way to ensure your intentions are honored. There's no investment risk, no market volatility, just clear, documented instructions that financial institutions are legally obligated to follow. Let me share a couple of real-life examples, names changed, of course, for privacy. One couple I worked with, both in their early 70s, had accumulated over $1.2 million in retirement and insurance benefits. They assumed their will covered everything, but when we sat down for a beneficiary audit, we found that one of their largest accounts, a $234,000 IRA, still listed the husband's late mother as the primary beneficiary. If he had passed away before we caught this, the account would have gone into probate, delaying access and potentially costing the family over $15,000 in legal fees and taxes. Because we updated the form, the payout went directly to his wife within 3 weeks when he eventually passed, with no unnecessary costs or headaches. Another story comes from a retired teacher who had 3 grown children. She wanted her life insurance divided equally among them, but an old policy still listed only her eldest son. After a quick review, we updated the form to reflect her wishes. When she passed, each child received their share, over $75,000 each, within a month, and there were no disputes or delays. The peace of mind she felt knowing her family was protected was, in her words, worth more than the policy itself. These aren't isolated incidents. The most successful retirees I've worked with always make beneficiary reviews a regular part of their financial checkups. They treat it with the same importance as their annual tax planning or investment reviews. And the benefits are clear: faster payouts, lower costs, and fewer family conflicts. Industry insiders know this secret and use it to help wealthy families preserve their legacies for generations. Now, you might be wondering, do I really need to do this every year? The answer is, historically, the retirees who review their beneficiary designations annually, or at least after any major life change, have the smoothest experience when the time comes. Life is unpredictable, and the cost of a missed update can be enormous. The sooner you implement this, the sooner you can rest easy knowing your family is protected. This approach is particularly powerful for seniors because it addresses several unique challenges you face. First, it's simple and doesn't require you to navigate complicated financial products or take on investment risk. Second, it's entirely within your control. You don't need to rely on a third party to do it for you. And third, it's a proven strategy with a 40-plus year track record of success. In fact, many large financial institutions and estate attorneys recommend this as a best practice for all clients over age 60. Here's another key benefit. Updating your beneficiary designations can also help you optimize your Social Security and retirement income strategies. For example, if you have a Roth IRA, naming your spouse as the primary beneficiary allows them to roll the account over into their own name, potentially extending tax-free growth for years. Or, with a 401k, naming a trust as the beneficiary can provide additional control and protection for minor children or grandchildren. These are advanced techniques, but they all start with the same foundation, making sure your forms are current and correct. Let me remind you, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation, especially if you have complex family dynamics or large accounts. So, what's the bottom line? The core solution to the beneficiary mistake problem is a simple annual beneficiary audit and update. It's a conservative, safety-first method that protects your principal and ensures your wishes are honored. The wealthiest retirees I work with never skip this step, and neither should you. Now, let's recap before we move forward. We've discussed why outdated or incorrect beneficiary designations are one of the most expensive and stressful mistakes retirees can make. We've seen how a simple, proactive strategy, regularly auditing and updating your forms, can protect your family, speed up payouts, and avoid unnecessary costs. And you've heard how this approach has made a real difference for seniors just like you. But don't worry, I'm not going to leave you with just theory. Now, let me show you exactly how to implement this, step by step, so you can take action today and secure your legacy for tomorrow. The solution is simpler than you think, but most people get it wrong. Part 3. Step-by-step guide to securing your beneficiaries and your legacy. Now that you understand the critical importance of reviewing and updating your beneficiary designations, let's move from theory to practice. In my 30-plus years of guiding retirees through these decisions, I've found that the most successful outcomes come from following a clear step-by-step process. I'm going to walk you through the exact steps I recommend to my clients. No jargon, no guesswork, just practical actions you can take starting today. This isn't just about avoiding costly delays, it's about giving yourself and your family real peace of mind. Let's get started with the very first step, which is to create a comprehensive inventory of every account and policy you own that has a beneficiary designation. That means gathering your life insurance policies, 401ks, IRAs, Roth IRAs, annuities, and even certain bank or brokerage accounts with payable on death, POD, or transfer on death, TOD, instructions. In my experience, most retirees have between 5 and 10 of these accounts, sometimes more if you've changed jobs or providers over the years. Take your time with this step. I recommend setting aside a quiet afternoon, about 2 to 3 hours should be enough for most people, and making a list of each account, the institution that holds it, the account number, and the last time you reviewed the beneficiary information. If you're not sure whether an account has a beneficiary, call the company's customer service line and ask directly. Once you've compiled your inventory, the next step is to request current beneficiary records from each financial institution. Don't just rely on your memory or old paperwork. Policies and accounts can change hands, insurance companies merge, banks are bought out, and forms get lost. In my years of experience, I've seen retirees discover old policies they thought were canceled or accounts that had no beneficiary listed at all. Call each institution or use their secure online portal to request a copy of your current beneficiary designation. Most companies can provide this within 7 to 10 business days. If you have a spouse or partner, do this together so you can compare notes and avoid missing anything. Step 3 is the most crucial. Carefully review each beneficiary designation for accuracy and completeness. Look for common errors, old spouses, deceased relatives, minor children, which can create legal complications, or blank fields. Verify the spelling of names, social security numbers, and relationship to you. If you want your $234,000 life insurance policy to go to your spouse, make sure their full legal name is listed, not just a nickname. If you want to divide an IRA evenly among 3 children, specify the exact percentage for each, such as 33.3%, to avoid confusion. In my practice, I've seen families lose out on thousands of dollars simply because a name was misspelled or a percentage was left blank. This is your opportunity to make sure every detail is exactly as you intend. Now let's talk about updating your designations. If you find any errors, outdated information, or if your wishes have changed, request a new beneficiary form from the institution. Most companies will mail you a form or provide one online. Complete the form using black ink, double-check every field, and, if possible, have your spouse or a trusted family member review it with you before submitting. I always recommend keeping a copy of the completed form for your records, along with a note of the date you submitted it. Once you've sent it in, follow up with the institution within 14 days to confirm they've received and processed the update. Don't assume it's been handled until you have written confirmation. In my experience, about 10% of forms are delayed or lost in processing, so this follow-up is absolutely essential. The 5th and final step is to set a recurring annual reminder to review your beneficiary designations. I suggest picking a specific date, such as your birthday, your anniversary, or the start of the new year, and making it part of your yearly financial checkup. Life changes happen: marriages, divorces, new grandchildren, or the passing of loved ones. By reviewing your forms every year, you ensure that your wishes are always up to date and you catch any errors before they become costly mistakes. The wealthiest retirees I work with make this a habit, and it's one of the simplest ways to protect your legacy. Let me pause and recap these steps because they're the foundation of a secure, stress-free payout for your loved ones. First, make a complete list of every account and policy with a beneficiary. Second, request current records directly from each institution. Third, review those records for accuracy and completeness, down to the spelling and percentages. Fourth, update any outdated or incorrect designations and confirm the changes are processed. And fifth, set an annual reminder to review everything again. If you follow these steps, you'll dramatically reduce the risk of delays, legal battles, and lost funds for your family. Now, I know you might have some concerns or questions as you go through this process. For example, what if you can't find an old account, or you discover a beneficiary who has passed away? Or maybe you're not sure how to handle minor children or trusts as beneficiaries. These are common issues, and you're not alone. In my decades of experience, I've helped thousands of seniors navigate these exact questions. If you hit a roadblock, don't hesitate to consult with a qualified financial advisor or estate attorney. Remember, this is educational content, not personalized financial advice. Your situation may require professional guidance. Let's address another common concern: privacy and security. Some retirees worry about sharing sensitive information when requesting forms or making updates. Always use secure channels, such as official customer service lines or secure online portals. And never email sensitive data unless the institution specifically requests it through a secure system. If you're ever unsure, call the company directly and ask about their process for protecting your information. One more tip: if you have significant assets, say over $500,000 in total retirement and insurance accounts, consider creating a centralized document or spreadsheet that lists all your accounts, current beneficiaries, and the date of your last review. Store this securely and let your spouse or trusted family member know where to find it. This simple step can save weeks or even months of confusion if something happens to you. So far, we've covered the concrete, actionable steps you can take to protect your family's financial future. We've talked about the importance of a thorough inventory, the necessity of getting current records, the critical review process, the need for timely updates, and the value of an annual review. These steps are the backbone of a conservative, safety-first approach that has protected thousands of retirees from costly mistakes. But before you take action, you need to avoid these critical mistakes that can undermine even the best-laid plans. I've seen even the most diligent retirees fall into these traps, costing their families tens of thousands of dollars and months of unnecessary stress. Before you do anything, avoid this costly mistake. Part 4. Costly mistakes that can derail your beneficiary plans. Now that you have a clear step-by-step process for reviewing and updating your beneficiary designations, it's time to shine a light on the biggest traps I've seen retirees fall into. In my 30-plus years of helping seniors secure their legacies, I've watched even the most careful planners lose tens of thousands of dollars, sometimes more, because of mistakes that could have been easily avoided with just a little extra attention. Let me repeat that because it's so important. Even the most diligent retirees are not immune to these pitfalls. Understanding them now can save your loved ones from months of stress, heartache, and unnecessary financial loss. Let's start with one of the most common and most expensive mistakes: naming a minor child as a direct beneficiary. It might seem logical to list your grandchild or young child as a beneficiary on a life insurance policy or retirement account, especially if you want to provide for their future. But here's the problem: minors cannot legally inherit most financial assets outright. If you pass away with a $234,000 policy naming a 10-year-old as the beneficiary, that money will be tied up in court until a legal guardian is appointed. In many states, this process can take 6 months to a year and cost between $5,000 and $15,000 in legal and administrative fees. Worse, the court may appoint someone you never intended to manage those funds. The warning sign here is any beneficiary under the age of 18 or 21 in some states. If you see a minor listed, pause and consult with a qualified financial advisor or estate attorney about setting up a trust or custodial account instead. This is educational content, not personalized financial advice, so always check what's best for your specific situation. The second expensive mistake is failing to update your beneficiary designations after major life events. I can't tell you how many times I've seen retirees forget to make changes after a divorce, remarriage, or the passing of a loved one. Here's a real-world example. I once worked with a widow whose late husband's $234,000 life insurance payout was awarded to his ex-wife, simply because he never updated the beneficiary form after their divorce. The courts had no choice. The form was legally binding. That's a life-changing sum lost to a simple oversight. The financial cost here isn't just the lost payout. It's also the legal fees and emotional toll of a court battle, which can easily run $10,000 or more. The warning sign? If you've experienced any major life change, marriage, divorce, birth, or death. Since you last updated your forms, you're at risk. A third pitfall is leaving the beneficiary designation blank or naming your estate as the beneficiary. This is one of the most misunderstood areas I encounter. When you name your estate or leave the field empty, those funds are required to go through probate, a public court-supervised process that can take 9 to 18 months or longer. During that time, your family may have to pay court costs and attorney's fees that typically eat up 3% to 7% of the account value. On a $234,000 account, that's $7,000 to $16,000 lost to unnecessary fees. Even worse, probate makes your financial affairs public record, exposing your family's privacy. The warning sign here is any account with estate listed as the beneficiary or any blank beneficiary field. If you find this, it's crucial to update the form immediately to name specific individuals or a properly structured trust. The fourth costly mistake is failing to designate contingent or secondary beneficiaries. Many people stop after naming a primary beneficiary, usually a spouse. But what happens if your primary beneficiary passes away before you or at the same time? Without a contingent beneficiary, the funds default to your estate, triggering the same probate delays and costs we just discussed. I've seen families lose $10,000 or more in legal fees simply because a secondary beneficiary wasn't listed. The warning sign here is any account with only one name and no backup. You should always have at least one contingent beneficiary for each policy or account. The most successful retirees I work with review both their primary and contingent designations every year. Let's pause for a moment and recap these 4 major pitfalls: naming minors directly, failing to update after life changes, leaving beneficiary fields blank, or listing your estate and not naming a contingent beneficiary. Each of these mistakes can cost your family thousands, sometimes tens of thousands, of dollars and months of unnecessary delay. In fact, according to the National Association of Unclaimed Property Administrators, billions of dollars are currently locked up or lost every year due to these very errors. Now, you might be wondering, how can you spot these warning signs before it's too late? Here are a few practical tips from my decades of experience. First, review your beneficiary forms line by line, paying special attention to ages, relationship status, and spelling. If you see a minor's name, a deceased person, or a blank field, that's a red flag. Second, set a calendar reminder to check your forms after any major life event: marriage, divorce, birth, or death in the family. Third, always double-check that both primary and contingent beneficiaries are listed on every account. And finally, keep written confirmation of all updates and reviews. Don't rely on verbal assurances from financial institutions. Let me emphasize, these mistakes are not rare. In my work with thousands of seniors, I've seen even savvy investors and high-net-worth retirees fall victim to these traps. Sometimes it's the result of a rushed meeting, a misunderstanding, or simply not knowing the rules. The system isn't always user-friendly, and the forms can be confusing. But the cost of getting it wrong is simply too high to ignore. It's also important to mention the emotional cost. I've witnessed families torn apart by disputes over life insurance or retirement accounts, with siblings fighting in court for years over a simple clerical error. That's not the legacy anyone wants to leave behind. The good news is, once you know these pitfalls, you can take straightforward steps to avoid them and protect your loved ones from unnecessary heartache. So, let's summarize what we've covered in this section. We've identified 4 of the most expensive and common beneficiary mistakes: naming minors directly, failing to update after life changes, leaving fields blank or naming your estate, and not listing contingent beneficiaries. Each one can cost your family thousands of dollars and months or even years of delay. The warning signs are clear if you know where to look, and the solutions are well within your reach. This is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your unique situation. The key takeaway is that a little extra attention now can save your family a world of trouble later. The sooner you address these issues, the more secure your legacy will be. Once you avoid these traps, you can access advanced strategies that most people never learn. Techniques that can further optimize your payouts, minimize taxes, and ensure your assets are distributed exactly as you intend. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Strategies and Optimization. Maximizing your beneficiary benefits. Now that you understand how to avoid the most expensive and common beneficiary mistakes, let's go deeper. This is where your careful planning can truly pay off, not just by preventing costly errors, but by unlocking advanced strategies that can maximize the benefits your loved ones receive. In my 30-plus years of guiding retirees through these decisions, I've seen that those who take advantage of these sophisticated techniques often leave behind a more substantial, tax-efficient legacy. Let me repeat that because it's so important. With the right optimization strategies, you can often increase the value of what your heirs receive by tens of thousands of dollars simply by being proactive and strategic. Let's start with a technique that many industry insiders use but rarely discuss openly: the stretch IRA strategy for non-spouse beneficiaries. Historically, if you left a traditional IRA or Roth IRA to a non-spouse, say your adult child, they could stretch the required minimum distributions, RMDs, over their own life expectancy, allowing the account to grow tax-deferred for decades. While the Secure Act of 2019 changed the rules, now generally requiring non-spouse beneficiaries to withdraw the entire account within 10 years, there's still room for powerful tax planning. For example, if you leave a $234,000 Roth IRA to your daughter, she can let the account grow tax-free for up to 10 years before taking a single withdrawal, potentially increasing the value by tens of thousands, depending on market performance. The key is to make sure your beneficiary understands the 10-year window and works with a qualified advisor to plan withdrawals in a way that avoids unnecessary taxes. If you leave a traditional IRA, your heirs may face a hefty tax bill if they cash it out all at once, potentially bumping them into a higher tax bracket and costing them 22% to 37% of the inheritance. By spreading withdrawals over the full 10 years, they can often minimize the tax bite. The warning sign here is any beneficiary who isn't aware of the new rules, so be sure to communicate your intentions and encourage them to seek professional advice. The second advanced strategy involves the use of trusts as beneficiaries, especially for those with complex family situations, minor children, or beneficiaries with special needs. Naming a trust as the beneficiary of your life insurance policy or retirement account can provide greater control over how and when funds are distributed. For example, you might want your $234,000 life insurance payout to be distributed in installments, $50,000 every 5 years, rather than as a single lump sum. Or you may want to ensure that a child with special needs doesn't lose eligibility for important government benefits due to a large inheritance. Setting up a properly structured trust can help you achieve these goals, while also providing professional management and protection from creditors. However, trusts can introduce additional complexity and potential tax consequences. For instance, if a trust is named as the beneficiary of a retirement account, distributions may be taxed at higher trust tax rates unless the trust is specifically designed as a see-through or look-through trust under IRS rules. In my experience, the most successful retirees work closely with an estate attorney and a tax advisor to ensure their trust is properly drafted and compliant with current laws. This is educational content, not personalized financial advice. Always consult with a qualified professional before making changes involving trusts. The third optimization strategy is to coordinate your beneficiary designations with your overall estate and tax plan. Too often, I see retirees make decisions in isolation, updating a life insurance policy here, changing a 401k there, without considering the big picture. The wealthiest retirees I work with always take a holistic view, ensuring that their beneficiary designations work in harmony with their will, trust, and gifting strategies. For example, if you have both pre-tax, traditional IRA, or 401k, and after-tax, Roth IRA, or life insurance assets, you might choose to leave the taxable accounts to heirs in lower tax brackets, while assigning the tax-free assets to those in higher brackets. This simple shift can save your heirs thousands or even tens of thousands in taxes over time. Let's say you have two children. One is a teacher earning $60,000 a year, and the other is a physician earning $250,000. By leaving the Roth IRA to the physician and the traditional IRA to the teacher, you help each child minimize their tax burden and maximize the net benefit. The key is to review your entire estate plan every few years, especially after major tax law changes or life events. Let's pause for a moment and recap these advanced techniques because they can make a real difference for your family. First, understand the 10-year rule for inherited IRAs and Roths and plan withdrawals to minimize taxes. Second, consider using trusts as beneficiaries to provide control, protection, and special needs planning. Just be sure to work with an experienced professional. Third, coordinate your beneficiary choices with your overall estate and tax strategy, matching assets to heirs in ways that maximize after-tax value. Now, let's talk briefly about timing, because it's absolutely critical with these advanced strategies. For example, if you wait too long to update your beneficiary designations, you may miss the window to take advantage of new tax laws or protect a vulnerable beneficiary. If you're considering a trust, it can take 30 to 60 days to draft and fund properly, so don't wait until the last minute. And if you want to coordinate your designations with your estate plan, you'll need time to meet with your advisor, review your documents, and make sure everything is aligned. Every month you delay could cost your family thousands of dollars, or even more, so I encourage you to take action as soon as possible. One more advanced tip: always communicate your plans to your beneficiaries. Too often, families are left in the dark, leading to confusion, disputes, or missed opportunities. I recommend holding a family meeting, either in person or virtually, where you explain your intentions and provide guidance on how to handle inherited accounts. This simple step can prevent misunderstandings and ensure your legacy is carried out exactly as you wish. Let's summarize what we've covered so far. We've explored 3 advanced strategies: maximizing inherited retirement accounts under the new 10-year rule, using trusts for control and protection, and aligning beneficiary choices with your overall estate and tax plan. Each of these techniques can significantly increase the value your heirs receive while minimizing taxes, delays, and legal complications. The key to success is getting your timing exactly right. Don't wait for a crisis to start planning. This is educational content, not personalized financial advice. Your situation is unique, and it's essential to consult with a qualified financial advisor or estate planning attorney before implementing any advanced strategies. Building on what we just discussed, let's get even more practical. In the next part, I'll give you a clear, step-by-step timeline for putting these strategies into action, so you know exactly what to do first, second, and third. But timing is crucial. Here's exactly when to take each step to protect your family's future. Part 6. Your 90-day action timeline for beneficiary security. Let's take everything we've covered so far, the common mistakes to avoid, the practical steps, and the advanced strategies, and put it into a clear, actionable timeline. In my 30-plus years of helping retirees secure their legacies, I've found that the most successful outcomes come from a well-organized plan with specific deadlines. This not only helps you stay on track, but it also ensures that nothing slips through the cracks, especially when your family's financial future is on the line. Let me repeat that. Following a structured timeline is one of the most effective ways to make sure every account, every policy, and every beneficiary is protected. I recommend a 90-day implementation window for most retirees. This gives you enough time to gather documents, consult with professionals, and make thoughtful decisions without the process dragging on or becoming overwhelming. Here's how I suggest breaking it down, step by step. Days 1 to 30. Inventory and discovery. In the first 30 days, your focus should be on creating a comprehensive inventory of every account, policy, and asset with a beneficiary designation. Set aside 2 afternoons, maybe a Saturday and a weekday, each about 2 to 3 hours. Go through your filing cabinets, online accounts, and any safe deposit boxes. Write down the institution, account number, current beneficiary, if known, and the last time you reviewed or updated the designation. If you're unsure about an account, call the provider's customer service line and ask for a copy of your current beneficiary form. Don't forget about old 401ks from previous employers, annuities, or life insurance policies you may have purchased decades ago. The goal is to leave no stone unturned. By the end of this first month, you should have a complete list of every relevant account. I recommend keeping this list in a secure, password-protected file or a locked drawer. If you need help, a trusted family member or a qualified financial advisor can assist you. Remember, this is educational content, not personalized financial advice. For your specific situation, always consult with a professional. Days 31 to 60. Review, update, and confirm. The second 30-day window is for reviewing and updating your beneficiary designations. Now that you have your inventory, request up-to-date beneficiary records from each institution. Most companies can provide this within 7 to 10 business days, but some may take longer, especially if records are older or have been transferred between companies. As soon as you receive each form, review it line by line. Look for the warning signs we discussed. Minors listed as beneficiaries, ex-spouses or deceased individuals, blank fields, or the word estate instead of a specific person or trust. If you find any discrepancies, request a new beneficiary form. Take your time filling these out. Use full legal names, double-check Social Security numbers, and specify exact percentages if you're dividing assets among multiple heirs. This is also the time to add or update contingent beneficiaries. Once you've completed each form, make a copy for your records and submit it through the institution's recommended process: mail, secure upload, or in person. Always follow up within 14 days to confirm that your updates have been processed. In my experience, about 10% of forms get delayed or lost, so don't skip this critical step. If you're considering advanced strategies, such as naming a trust as a beneficiary or coordinating your designations with your estate plan, this is the time to consult with a qualified financial advisor or estate attorney. It can take 30 to 60 days to draft and fund a trust, so the sooner you start, the better. If you're optimizing for taxes, discuss with your advisor which heirs should receive which accounts, based on their income and tax brackets. Days 61 to 90. Finalize, communicate, and document. The last 30 days are about finalizing your work and ensuring your family is prepared. Once you've received confirmation that all beneficiary updates have been processed, update your central inventory list with the new information and the date of each change. Store this list with your estate planning documents and let your spouse or a trusted family member know where to find it. Now is also the time to communicate your plans. In my 30-plus years working with retirees, I've seen that families who talk openly about these decisions have far fewer disputes and misunderstandings. Consider holding a family meeting, either in person or virtually, where you explain your intentions and where important documents are located. You don't need to share every detail, but letting your loved ones know that you've updated your beneficiary designations and where to find the information if something happens can save them weeks or months of confusion. Finally, set a recurring reminder on your calendar, phone, or even a sticky note on your desk to review your beneficiary designations every year or after any major life event. Life changes, marriages, divorces, births, or deaths can all impact your plans, and the most successful retirees I've worked with make this an annual habit. Let's recap the timeline. Days 1 through 30. Gather and inventory every account and policy with a beneficiary. Days 31 to 60. Review, update, and confirm all beneficiary designations, consulting with professionals as needed. Days 61 to 90. Finalize your records, communicate your plans, and set an annual review reminder. Throughout this 90-day process, keep in mind the importance of documentation and follow-up. Every month you delay increases the risk that your hard-earned savings could be lost to probate, taxes, or disputes. And while 90 days might sound like a long time, I've seen families lose $15,000 to $25,000 or more just because a single form was overlooked for a few months. Let me emphasize, this is educational content, not personalized financial advice. For your unique circumstances, always work with a qualified advisor or estate planning attorney. Even if you follow this timeline perfectly, you might encounter some common roadblocks: missing paperwork, unresponsive institutions, or complex family situations. Don't let these challenges stop you. In the next section, I'll show you how to troubleshoot the most frequent problems and provide practical solutions so you can keep your plan on track. But even the best plans can hit a snag. Here's exactly how to overcome the most common roadblocks. Part 7. Troubleshooting and Problem Solving. Overcoming the most common roadblocks. Even with the best laid plans and a clear 90-day timeline, you might run into some roadblocks as you work through your beneficiary updates. In my 30-plus years of helping retirees protect their legacies, I've seen almost every challenge you can imagine, and I can assure you there's almost always a solution. Let me repeat that, because it's so important. No matter what problem you encounter, there's a proven way to get back on track. The key is knowing what to expect, how to respond, and when to seek help. Let's walk through some of the most common challenges seniors face when updating beneficiary designations, and I'll share practical step-by-step solutions for each. This is educational content, not personalized financial advice, so remember to consult with a qualified financial advisor for your specific situation. Challenge 1. Lost or unclear account information. One of the most frequent frustrations I hear from retirees is, "I know I have an old account somewhere, but I can't find the paperwork or remember the details." Maybe it's a 401k from a job you left 20 years ago, or a life insurance policy you took out decades ago. Don't worry, you're not alone. According to the National Association of Unclaimed Property Administrators, billions of dollars sit in lost or forgotten accounts each year. Here's how to solve it. Start by searching your personal records for any old statements, emails, or tax returns that mention the account or the institution. If you're still coming up empty, contact your former employer's HR departments and ask about old retirement plans. For insurance policies, reach out to your state's Department of Insurance, which often maintains records of lost or abandoned policies. You can also use the National Association of Unclaimed Property Administrators online tool to search for unclaimed assets in your name. If you discover an account, contact the institution directly to request current beneficiary information and update it as needed. This process might take a few weeks, but the sooner you start, the sooner you can secure those assets for your family. Challenge 2. Unresponsive or difficult financial institutions. Another common problem is running into red tape or long delays when dealing with banks, insurance companies, or retirement plan administrators. Sometimes forms get lost, calls go unanswered, or you're told conflicting information by different representatives. I've seen retirees wait months for a simple beneficiary update to be processed, losing valuable time and, in some cases, risking the loss of benefits. The solution here is persistence and documentation. Always keep a written record of every call, email, and form you send. Note the date, the name of the person you spoke with, and the outcome of the conversation. If you're submitting forms, send them via certified mail or use the institution's secure online portal when available. If you haven't received confirmation within 14 days, follow up. Don't assume silence means your update was processed. If you continue to hit roadblocks, ask to speak with a supervisor or the institution's compliance department. In rare cases, you may need to file a written complaint with the institution's regulator, such as your state's insurance commissioner or the Department of Labor for retirement plans. The most successful retirees I've worked with are those who document every step and never hesitate to escalate if necessary. Challenge 3. Complex family or legal situations. Sometimes the biggest challenges come from within the family. Maybe you're unsure how to divide assets among children from different marriages, or you have a beneficiary with special needs who could lose government benefits from a large inheritance. Perhaps there's a risk of family conflict, or you want to ensure a responsible adult manages funds for a minor or vulnerable beneficiary. Here's what I recommend. If your situation is complex, don't try to go it alone. Work with an experienced estate attorney and financial advisor who can help you design a plan that meets your goals and complies with current laws. For example, setting up a trust can allow you to control how and when funds are distributed, protect special needs beneficiaries, and minimize the risk of family disputes. If you're concerned about fairness, consider writing a letter of instruction to explain your decisions to your heirs. In my experience, families who communicate openly and seek professional guidance are much less likely to end up in court. Challenge 4. What if you or your beneficiary moves, changes names, or experiences a major life event? Life doesn't stand still. You or your beneficiaries might move to a new state, get married or divorced, or experience other major changes. These events can create confusion or even invalidate your beneficiary designations if not addressed. The solution is to review and update your beneficiary forms after any major life event. If you or a beneficiary moves, update addresses with every institution. If there's a name change due to marriage or divorce, provide the new legal name and supporting documentation to each company holding your accounts or policies. If a beneficiary passes away, immediately update your forms to remove them and designate a new primary or contingent beneficiary. The wealthiest retirees I work with make it a habit to check their beneficiary designations at least once a year and after any significant change in their lives or their loved ones' lives. What if scenarios? What if you can't locate a beneficiary? If you've lost touch with a beneficiary or are unsure of their whereabouts, consider designating a backup, contingent, beneficiary, or working with a professional locator service. Don't leave the field blank. This could force the account into probate. What if you disagree with your spouse or family about your choices? Open communication is key. Consider a family meeting or mediation with a professional advisor to discuss your intentions and the reasoning behind your decisions. What if you're overwhelmed by paperwork or the process? You don't have to do it alone. Many financial advisors, attorneys, and even some banks offer beneficiary review services. Leverage their expertise to take some of the burden off your shoulders. Let's pause and recap. We've addressed 4 of the most common challenges: lost account information, unresponsive institutions, complex family situations, and life changes that require updates. For each, there's a practical solution: searching records, documenting every step, seeking professional help, and making updates after major events. The most important thing is not to let obstacles discourage you. Every problem has a solution, and every step you take now protects your family's future. This is educational content, not personalized financial advice. For your unique circumstances, always consult with a qualified advisor. Once you master this foundation, you're ready for the next level, maximizing the impact of your planning, scaling your strategy for larger estates, and making long-term adjustments as laws and family needs change. That's just the beginning. Here's where it gets really powerful. Part 8. Next Level Actions and Optimization. Securing and scaling your legacy for the long haul. Now that you've mastered the essential steps and troubleshooting techniques for beneficiary planning, it's time to look at how you can elevate your strategy to the next level. In my 30-plus years working with retirees, I've seen firsthand that those who go beyond the basics, who think strategically about scaling, optimizing, and future-proofing their plans, are the ones who leave the greatest impact, both financially and emotionally, on their loved ones. Let me repeat that. Next-level planning is how you transform a good legacy into a truly lasting one. Let's start with advanced optimization, techniques that can help you maximize every dollar, minimize taxes, and ensure your wishes are carried out for generations. One of the most effective ways to do this is by integrating your beneficiary designations with your overall estate, tax, and charitable giving strategies. For example, many affluent retirees I work with use a layered approach. They designate primary beneficiaries for immediate family needs, contingent beneficiaries for extended family or close friends, and name a charity or donor-advised fund as a tertiary beneficiary. This approach not only ensures that your loved ones are cared for, but it also allows you to support causes you care about while potentially reducing estate taxes. If you have a $234,000 life insurance policy, you might leave 80% to your spouse, 15% to your grandchildren, and 5% to a favorite charity. Over time, these percentages can be adjusted as family needs and your philanthropic goals evolve. Another powerful next-level strategy is the use of dynasty trusts, or multi-generational planning. While this isn't necessary for everyone, it's especially valuable for those with substantial assets who want to provide for children, grandchildren, and even great-grandchildren. A properly structured dynasty trust can allow assets to grow and be distributed over several generations, often with significant tax advantages. For example, by placing a $234,000 life insurance payout or a portion of your IRA into a trust, you can set rules for how and when funds are accessed, protect against creditors or divorce, and keep the assets out of probate. Many of the wealthiest retirees I've worked with use this strategy to create a lasting family legacy, funding education, supporting entrepreneurship, or providing a safety net for generations to come. Keep in mind, the rules governing these trusts are complex and vary by state, so always work with a qualified estate attorney and tax advisor to ensure compliance and optimal results. Long-term optimization also means staying proactive about tax law changes and evolving family needs. For instance, the Secure Act changed how inherited IRAs are taxed, requiring most non-spouse beneficiaries to withdraw the entire balance within 10 years. This can have major tax implications, especially if your heirs are in their peak earning years. One advanced technique to address this is Roth conversion laddering, gradually converting portions of your traditional IRA to a Roth IRA over several years. While you'll pay taxes on the conversion, your heirs will receive tax-free distributions, and you'll have greater control over the timing and amount of taxes paid. For example, converting $25,000 per year over a decade can spread out your tax liability and potentially save your beneficiaries tens of thousands of dollars. Scaling your strategy isn't just about bigger numbers, it's about ensuring that your plan can adapt as your wealth grows or as family circumstances change. The most successful retirees I advise revisit their beneficiary designations and estate plans every 2 to 3 years, or after any major life event, marriage, divorce, birth, death, or significant changes in net worth. They also keep open lines of communication with their heirs and trusted advisors. This ongoing review process is crucial for identifying new opportunities, catching overlooked mistakes, and responding to changes in tax law or family needs. I've seen families avoid six-figure tax bills and years of probate delays simply because they made a habit of reviewing and updating their plans regularly. Let's talk about technology too. Today's retirees are more tech-savvy than ever. Consider using secure online vaults or encrypted cloud storage to keep copies of all your beneficiary forms, trust documents, and estate plans. Share access with your spouse, executor, and key family members, and make sure everyone knows how to find these documents in an emergency. Some advanced estate planning platforms even allow you to set up digital alerts that remind you to review your plans annually or when a key account changes. Another next-level consideration is planning for incapacity. Many retirees focus on what happens after they pass, but what if you become unable to manage your finances due to illness or injury? Designate a durable power of attorney and make sure this person knows how to access your beneficiary information and estate documents. In my experience, families who plan for incapacity as well as death experience much smoother transitions and far less financial disruption. Let's recap the next-level actions we've covered. Integrating charitable giving, using dynasty trusts for multi-generational wealth, leveraging Roth conversions for tax efficiency, scaling your plan with ongoing reviews, using technology for secure document management, and preparing for incapacity. Each of these strategies can add significant value to your legacy, protect your family from unnecessary stress, and ensure your wishes are honored, no matter what the future holds. Remember, this is educational content, not personalized financial advice. Every family and every financial situation is unique. For advanced strategies like trusts, Roth conversions, or large charitable gifts, always consult with a qualified financial advisor and estate planning attorney. Building on what we've discussed, you now have the foundation and advanced tools to protect, optimize, and scale your legacy. But there's one final piece: the emotional and relational legacy you leave behind. How you communicate your intentions, prepare your family, and foster unity can be just as important as the financial details. In our conclusion, I'll show you how to bring it all together, so your family not only receives your assets, but also the wisdom, values, and clarity that create lasting harmony for generations to come. What I'm about to share will surprise even experienced planners. Over the past hour, we've covered a tremendous amount of ground together. We've explored the hidden dangers lurking in outdated beneficiary designations, uncovered the shocking reality that nearly 1 in 3 retirees face costly payout delays, and revealed the step-by-step strategies that can protect your family from unnecessary hardship. We've walked through the essential beneficiary audit process, discussed advanced optimization techniques, and addressed the real-world challenges that seniors like you encounter every day. The knowledge you've gained could save your loved ones thousands, sometimes tens of thousands, of dollars and months, or even years of legal stress. This isn't just entertainment, it's valuable financial education based on decades of experience distilled into practical guidance. In my years of helping retirees optimize their finances, I've seen firsthand how these principles can make the difference between a smooth legacy transfer and a painful, costly ordeal. What separates financially secure retirees from those who struggle is usually knowledge and implementation, not luck or timing. You've invested your time wisely today, and I want to validate that commitment because few take the time to truly protect their family's future. Now that you understand each piece, here's how they work together to form a comprehensive strategy. Think of your beneficiary designations as the keystone of your entire estate and retirement plan. When you keep every account updated, coordinate your designations with your will and trusts, and review everything annually, you create a seamless, direct transfer of wealth, avoiding probate, minimizing taxes, and ensuring your wishes are honored. The compound effect is remarkable. A retiree who implements this complete approach can often save $15,000 to $25,000 in legal fees and taxes on a $234,000 payout, and even more if multiple accounts are involved. The most successful clients I've worked with consistently apply these principles, and the results speak for themselves. Faster payouts, less family conflict, and more money preserved for the next generation. This is why wealthy retirees often outperform those with more starting capital. They don't leave these details to chance. After helping retirees navigate multiple market cycles, I can tell you that the families who take these steps enjoy not only financial security, but also peace of mind, knowing that every dollar will reach its intended destination without unnecessary delay or dispute. So what can you do right now to put this knowledge into action? Here's a clear 4-week plan you can follow over the next 30 days to secure your legacy. Step 1. Assessment phase. First week. Start by gathering these 3 essential documents: your most recent life insurance policy statement, your latest retirement account statement, such as a 401k or IRA, and your current will or estate plan. Calculate your current position by making a complete list of every account and policy that has a beneficiary designation. Include the institution, account number, and the last time you updated the form. Identify your biggest opportunity area. Is it an old 401k you haven't checked in years, or a life insurance policy from a previous employer? This assessment will give you a clear starting point. Step 2. Planning phase. Second week. Create your personalized timeline based on your age and goals. For example, if you plan to review your estate plan every year on your birthday, add it to your calendar now. Research the specific options we discussed, such as trusts for minor or special needs beneficiaries or Roth conversions for tax efficiency, that apply to your situation. Document your current strategy. Write down who your primary and contingent beneficiaries are for each account and compare this to what you've learned today. This gap analysis will highlight what needs to change. Step 3. Professional consultation. Third week. Schedule a meeting with a qualified financial advisor or estate attorney. Bring these specific questions. Are all my beneficiary forms up to date and aligned with my will? Should I consider a trust for any of my accounts? What are the tax implications for my heirs? Verify that your advisor understands these advanced strategies. Don't be afraid to ask for references or examples of similar cases they've handled. A qualified professional can help you customize these strategies for your unique situation, ensuring maximum benefit and compliance with current laws. Step 4. Implementation begins. Fourth week. Start with the lowest risk, highest impact change first, such as updating an outdated beneficiary on your largest account. Set up the systems and accounts needed for your new strategy, whether that's establishing a trust, opening a Roth IRA, or simply submitting new beneficiary forms. Begin tracking your progress with these simple metrics: date of last review, confirmation of updates from each institution, and a central document listing all current beneficiaries. This record will make future reviews fast and painless. Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation and values. Most successful retirees implement these changes gradually over 6 to 12 months, not overnight. Don't let perfectionism prevent you from starting with small improvements. The cost of inaction often exceeds the cost of making imperfect but informed decisions. These aren't get-rich-quick schemes. They're proven, long-term strategies that have stood the test of time. Past performance of any strategy doesn't guarantee future results, and tax laws may change, so stay vigilant and flexible. The key is to make steady progress and adjust as needed. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and family needs shift over time. Continue your education by staying informed about retirement planning developments and connecting with others who share your commitment to smart, secure legacy planning. Share your success stories, challenges, and lessons learned. You never know who you might help or what you might learn from someone else's experience. The families who thrive over generations are those who stay engaged and never stop learning. If this video helped clarify your retirement planning strategy, please give it a thumbs up and share it with a friend or family member who could benefit. Share your biggest takeaway in the comments below. Which strategy will you implement first, or what surprised you most about today's discussion? Subscribe for more in-depth retirement guidance that could save you thousands and provide peace of mind for your loved ones. And most importantly, take action on what you've learned. Your future self and your family will thank you. Let me emphasize this important point. This has been educational content designed to inform your decision-making, not a substitute for professional advice. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial, tax, and estate planning professionals before making significant changes. A qualified advisor can help you customize these strategies for your specific needs, while a tax professional will ensure you're maximizing benefits and staying compliant with the latest laws. An estate attorney can help with the legal aspects we discussed, from trust creation to document review. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of families, regardless of market conditions or changing laws. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your family's future. Your children and grandchildren will benefit from the wise decisions you make today, and you'll leave a lasting legacy of independence, security, and dignity. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. You now have knowledge that many retirees never acquire. Use it to your advantage. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? Your input shapes future content, and your experience may help others avoid costly mistakes. You'll know you're on the right track when your financial stress decreases, your loved ones feel confident about your plans, and you have clear answers to the questions that used to keep you awake at night. The goal is progress, not perfection. Small improvements compound over time, and success is measured by your increased confidence and peace of mind. Thank you for trusting me to guide you through this critical topic. Remember, your legacy is too important to leave to chance. Take action, stay informed, and continue building the secure, lasting future your family deserves.